Howdy, Hot Shots Dividend Daddy here, your favorite not a financial advisor with not financial advice. Today we're going to talk about hedging, Ulti hedging, or potential hedges for Ulti anyway. I got my flowery notebook here, and we're going to go over a little bit of figuring that I've been doing. That way we can see what you think is the best way to hedge Ulti, okay? A little bit of a spoiler alert. I don't think it's puts on Ulti, but I see a big problem with the puts on Ulti. Not to say that they obviously wouldn't hedge it well, but I think there might be a couple better options. Today was a little bit of a rough day in the market. Oh, you can see the burn there. I had a shell casing catching my shirt and burned my neck there. Today was a little bit of a rough day in the markets as it turned down towards the end of the day. My ETFs like VU and VUG and VGT, I think they were all down just a smidge. When I saw that my overall account value had gone down by, let's call it about 0.5% today, I thought that I was going to see Ulti was down. And I thought maybe some of my limit orders that I had purchased with my Ulti waterfall method would have filled. But I see that during the day, it went up to where it was worth over $6.10. And after hours, right now, it's $6.05. So it actually held up really well. I did a little bit of figuring on my cost basis, which was not that easy to do. I have Schwab, and I don't really... I had TD Ameritrade, and then Schwab bought them out. Now I have Schwab. I don't really like their app as much as I did TD Ameritrade's. It's a lot harder for me to see how much I've paid in aggregate for a security, the dividends that I've had, my overall return. I don't have a section on it. Maybe if I went on the website instead of the app, I could find a section that tells me my overall return, but it doesn't tell me that regularly or readily on the app. And that's where I would like to look, because obviously it's easier just to pull out my phone and look at my app. But I did some figuring. I figured out how much I had put in, and it's not that great, because I purchased over half of my shares up in the high 630s and 640s. In fact, my biggest single purchase was at 645, which was like the peak that Ulti has been at recently. I did that because I had just found out about Ulti just prior to that time period. And I started buying some shares when it was like $6.18, and it just kept going up, and I wanted to get in it. And so obviously, timing the market isn't as easy as some people on the YouTube ads and Facebook ads and everything try to make it seem. It's 50-50 at best. So I said, well, this is a pretty high distribution rate. Even if I pay a little bit too much for it, I'm going to get that back quickly, which I did. But I'm going to miss out on it if it keeps going up, and then I'm not going to get as high of a distribution yield. So I went ahead and bought a good chunk of shares at 645. Obviously, hindsight being 2020, if I knew the future, I would have waited and purchased the shares after they went down into the $6 range. But regardless, those shares have paid me 3 payouts now, I think. So the cost basis on that chunk of shares would be down in the $6.15 range. But I cost averaged up a little bit, and I cost averaged down more on the way down. So after my distributions and everything, I just did all the math. My cost basis is $5.96 a share. So with it at 605, I am in the green. Obviously, more in the green is better, but I am in the green. And now as I continue to get distributions, it'll put me more and more in the green. So I am happy, because if I would have waited until today to buy all of my shares, even though I would have gotten some of them at a lower price, if I bought that whole chunk of shares today, my cost basis would be $6.05. Right now, my cost basis is $5.96. So I am not hurt. And the lowest I've seen it get down to recently was $5.96. So basically, after all of my distributions that I've had for the last month or so that I've had it, my cost basis is exactly what the lowest price recently was. So that's pretty sweet. And that's all because of that big distribution. People are saying that it's all a return of your capital. Now, tax coding or the way that they mark their distributions, that might very well be true. Okay, as far as the IRS is concerned, maybe it is all return of capital, but there's no way that it could have all been return of capital when I paid $6.45 for a bunch of shares and bought shares all the way down to $6, and yet my cost basis is $5.96. So if I paid $6.45 and I was able to get my cost basis down to $5.96, how is that a return of my capital when the fund is still worth $6.05? I could sell it right now for $6.05. It wouldn't be a large profit. What is that about? Close to 2%, maybe 1.8%. I'd have to do some figuring. I don't have all the angles on my geometry, but I think that it's close. It's over 1% and less than 2%, up in like 1.8%-ish range. So how could I have a positive return if all they've been doing is giving me back the money that I put in? I can't, and that's the answer. And so even though over time, maybe they are giving you back some of the money out of the fund and it will drift lower, that is a possibility. As of right now, I have not been having my capital returned to me. It went down in value on the open market, but I'm green after having had 4 distributions and paying more for the fund than a lot of people have been paying for it recently. So I don't understand how that would be just giving me my money back. Obviously, I caught up a little bit, but that's my cost basis. I'm happy that it held up today, even though things went down, it still went up a little bit after market. So it's looking pretty strong. I do have a covered call on Elanco, E-L-A-N. I think they make the flea protection for dogs and stuff like that. I had bought some shares of it, sold a covered call, used the money from the covered call to purchase some shares in Ulti, and that I thought I would just do the wheel on that one. If you're not familiar with what the wheel is, if you buy a stock, you can either open your position with a cash covered put, or you can buy a stock, sell a covered call on it. It gets called away and you turn around and sell a put at the same strike price. So right now I had a $15 call out. I'm losing money on that call right now because the stock is up to like $16.74 or something like that. The strike price of $15 was a profitable trade for me regardless. Once I get those shares called away from me, I'll probably wait for a dip and see if it's advantageous for me to sell a cash covered put at $15. And I might just wheel that stock. At least that'll be my plan right now. We'll see. If it keeps going up, then it'll get too far away from $15 for me to make sell a put and get a good, decent return on it. And then I won't do that. But if it stays around $16, I could probably sell a $15 put. And then I will use the money that I get from the put to buy more Ulti. But I wanted to see a couple different ways that we could hedge Ulti, see what's beneficial to us. So I looked at buying puts on the Qs, on QQQ, which is a NASDAQ 100 fund. That's mostly growth stocks. So I feel like in a market downturn, in a tech downturn that would affect the high volatility stocks that Ulti is holding, the Qs might be a good representation of that. They might not go down as much as the stocks that Ulti holds, but Ulti also has some puts. So that will help cushion things as well. So if they've got puts and then I have additional puts outside of Ulti, maybe I could make sure that I don't lose any money. The only issue is that the Qs are $572-ish right now. So you would be hedging a rather large position if you were to do that. Now, it's not an exact hedge. If you're going to make the bet, you got to do the vet. All right. Okay. But for me and Gag, who want to buy our Pall Malls and cheap vodka, this is close enough. And I'm just going to go out there with a wag. For those of you who don't know, that's a wild ass guess, and say that buying puts on Qs would be a relatively good hedge. So if you were to go and buy, this would be protecting a $57,000 position, by the way. If you were to buy 570 strike puts 323 days out, so almost a year, they'd cost you $3,440-ish right now. That's about 6% for almost a whole year's worth of protection, about 11 months worth of protection. So if you're getting 85%, let's knock that down by 10% because it's not a full year. So say 75%. If you're getting a 75% yield, and this is assuming that Ulti continues to pay that yield. Okay, so that is a caveat that you have to think about. If you get 75% and it costs you roughly 6% to protect that position, it seems like a pretty good deal. Now, you could lay off some of that cost at a lower strike put. So you would buy the 570 strike put, and then you would sell a 520-ish strike put. That would protect you close to 10% downside in the tech market. And you would retrieve about $2,040 for laying off that cost. So your net cost would be $1,400, which would be 2.4%. So 2.4% for protection, 10% down in the market for about 11 months. That's pretty cheap, 2.4%. So if you did have a big downturn, if the market just totally collapsed, you would be somewhat protected for roughly 10% decrease in value. And you would still be getting the yield from Ulti. Now, obviously, if Ulti price goes down, the yield isn't going to be the same. So that is a caveat. But it only takes you a few weeks of distributions up front to cover the cost of that put. And then you would be back in the green. So if you just set aside like the first 3 distributions that you had, and then you bought a put, and like I said, this is for like a $57,000 position. So you would have to be pretty deep in Ulti to want that kind of protection. Otherwise, it multiplies. If you have $10,000 in Ulti, but you hedge with a $57,000 position, 10% down, that multiplication would give you a higher percentage cost, maybe 20 or 30% for the year. But if you're getting 85%, well, let's go with the 2.4% number. So roughly it would cost you about 12.5% for the course of the 11 months to get that downside protection on a 10% downside for 5 times the money that you had invested. So your 75% that we're calling it yield on Ulti would more than pay for that 12%. And you'd still have a really high yield, 75% minus 12.5, you're looking at 62.5%. So you're getting north, assuming Ulti continues to pay its distribution rate, you're getting north of a 60% yield while also being protected on the downside through your puts on the Qs. I like that one. I think that's my favorite one here. Another one I looked at was buying calls on the VXX, or which tries to mirror the S&P 500 VIX. It's a volatility index. Right now, if you were to buy calls about 9 months out at the money, they'd be $11, okay, which is about a 26.8% cost for that protection. So if the market got really rocky, if it just totally went down overnight, that VIX would shoot up, and then you would profit on those calls, which would compensate you for the money that you were losing on Ulti during that downturn. So that's another way that you could potentially hedge that position somewhat. Now, these are not one-for-one hedges. It's not guaranteeing that your money stays exactly where it's at, okay? One that would kind of guarantee that you wouldn't lose any of your principal would be buying $6 Ulti puts. So right now it's $6.05. If you bought $6 Ulti puts, they'd be about $1.30. That's 21.4%, but that's only going out 158 days, so not even 6 months. So you would still see a positive yield, assuming Ulti continues to pay that distribution rate, and you would be protected on the downside for those about 5 months past $6. So if it went down to $5, you'd make a dollar profit, assuming you still had all the time value, if it did it real soon. If it does it towards the end, some of that time value is eroded. I mean, you might still only break even on the calls, but hopefully your yield on Ulti in the meantime was able to pay for those, and then you would just be recouping your money. So you potentially could still have a loss on the puts, even if they were in the money at the end of the term. But hopefully the yield that you got on Ulti would counteract any losses that you had on the puts, and then any money you got back from the puts would be icing on the cake. That sounds really expensive to me. 21% for 158 days. You have to I mean, at 1% away, you're going to have to spend like 3.5 months ish of your distributions just to pay for those puts. So I don't like Ulti puts. I don't like Ulti puts for selling them. I don't like selling the puts because I don't think that the return is as high as if you get the distribution from Ulti itself. But I don't like buying the puts either because I think it costs too much for that protection. It's kind of like a fast food restaurant right now. When you look at fast food prices, you go, oh my gosh, they're charging way too much. But when you look at how much they have to pay the fast food workers and the insurance costs and the rent and everything like that, it's like, well, how are they even making any money? So I simultaneously think that I'm getting a bad deal, but the seller is not really getting a good deal either. You know, it's like, do I think they're charging too much? Yes. Do I think that they are making out like a bandit? No. So I don't really like Ulti puts for that reason. Now, if somebody else has a different opinion on that, you stick it down below. Tell me what you think. My favorite idea right now is to buy puts on the Qs. And if I keep right now, I'm just running naked. I'm like a streaker at FIFA. I'm just running naked. Okay. So I don't have any kind of hedge for Ulti at this point in time. I'm looking to hedge because once I figure out what hedge is going to still allow me to net the largest return, then I will be hedging and I will be going into Ulti a lot bigger. But right now I'm getting my feet wet. You know, I've got a couple thousand shares. I'm not exactly setting the world on fire, but I want to get on up in there. So I'm definitely looking for a good hedge. Ooh, sounds like a fighter jet, huh? Hopefully they're not coming for me. Anyway, I'll talk to you D-Gens later.